Welcome back to A to Z Equities, where we cover all US listed stocks from A to Z. Today we're covering AbbVie, a pharmaceutical giant, ticker ABBV. As always, we're going to be ranking this company on five different metrics, each on a scale from 1 to 5 stars. The five metrics are industry, price, growth, financial position, and management. And at the conclusion of the video, we are going to come up with a blended score, taking the average of those five scores from those five categories for a blended total score for this company. So without further ado, let's get into it, starting as always with industry. AbbVie, as mentioned, is a pharmaceutical company. Taking a look at their investor relations page, they discover, develop, and commercialize advanced therapies that have an impact on people's lives. And they have about 50,000 employees working together to help patients around the world. So, not a crazy amount of information here. As mentioned, AbbVie is one of the biggest pharmaceutical companies. They are a pharmaceutical giant headquartered in the US. Let's take a look at Wikipedia here. They are an American pharmaceutical company headquartered in North Chicago. So the company's primary product is Humira, administered via injection, 14 billion in 2023 revenues, and it treats all these different diseases. It also develops Skyrizi, which you may have seen television commercials for. Some other various drugs that are apparently currently, yeah, these are all currently active. They're given as percentages of 2023 revenues. Now, without getting, too deep into kind of, a qualitative comparison of AbbVie versus other pharmaceutical giants in the US and around the world, the pharmaceutical industry is a tough industry to be in for the simple reason that they constantly need to spend billions and billions of dollars on research and development to keep their research going, to keep their development pipeline going, to keep new drugs coming to market. Obviously, many of the drugs that they spend money to develop turn out to be failures. They don't do what they were intended to do, or they don't get the appropriate regulatory approvals. So that's one issue, with these companies. You never really know where their future bread and butter is going to come from. There are investors who specialize in pharmaceutical companies, and a huge part of that is the qualitative analysis of one drug versus another, and one company's pipeline and one company's portfolio of drugs versus another. Now, of course, the company already has the benefit of all these drugs that they've already developed. The issue with that is that, as many investors will be aware, there are limited patent windows for these drugs, limited exclusivity windows in which the company that developed the drug gets exclusivity to sell it while the patent is valid. However, once the patent runs out, imitators can come in and create generic versions of the drug. And at that point, usually the original will see sales fall off, we'll see price declines because they have to compete with generic competitors. And of course, they do have a little bit of residual value from the brand and the fact that they got to brand this kind of drug under their company's brand first. And of course, that will have some residual value even once the patent expires. They'll continue to make the drug, but chances are the price is going to be lower and the demand is going to be lower as well, as all these competitors are able to then compete. So the pharmaceutical industry is tough for that reason. By the same token, when you have a company like AbbVie, which is an industry leader, the industry actually plays to their benefit a little bit. And these huge barriers to entry, the billions of dollars that it takes to develop drugs that can compete with these major pharmaceutical giants like AbbVie, obviously prevents a lot of competitors from coming into the industry. They don't have the financing. There is a lot of uncertainty around how these companies are going to do in the future, and whether they are going to develop any successful drugs. And so the pharmaceutical industry is both a very tough industry to compete in, very high expenses, and a lot of uncertainty around what a company is going to be able to develop and achieve in the future. On the other hand, when you have a pharmaceutical giant like AbbVie, which is already in this business and is dedicating those billions of dollars, it's very hard for other companies to come along and start competing with them. And so that really plays both ways. Overall, I'm going to say that there's another factor that weighs against this industry, and that is a bit of a populist uprising around the world against the healthcare industry in general. And the pharmaceutical companies are a huge part of that ire that gets directed at the healthcare industry, I would say, especially in the US, and possibly in other places around the world as well. Now, AbbVie being a US company and obviously benefiting tremendously to the tune of billions of dollars a year from the way that the American healthcare industry currently works, AbbVie could stand to be negatively affected if political or legal changes are made that affect the prices it could charge for its drugs, the exclusivity of its patents, or anything along those lines. And so, of course, in some ways, regulation could actually benefit an industry, especially the bigger players in the industry who are best and most capable of weathering any new demands from regulators. But all of that said, uh, overall, you'd rather operate in a less regulated industry than a more regulated industry. And there are, of course, all these public sentiments, and it's hard to predict 10, 20 years from now how the healthcare industry might look different. Even just Medicare being able to negotiate the prices of prescription drugs or certain prescription drugs. And if that were to expand in the future, whether that's in 2 years, whether that's in 10 years, whether that's in 15 years, it could significantly affect a company like AbbVie. So, with all of that said, we're going to give AbbVie 2.5 stars for industry. Not a great start, and not much the company could do to control for that. Obviously, this is just the industry that the company operates in. Chances are that any similar company that we'd be looking at, any of AbbVie's major competitors, we'd be awarding the same industry score to, obviously, of 2.5. So, moving forward onto price, we'll see if AbbVie looks attractive on the basis of its valuation. So, looking at the income statement here, we have a few metrics that we like to look at. And of course, we would like to know what AbbVie's market cap is, what its total stock market value is. That would be very important to being able to assess the price. So, let's go over to Seeking Alpha. So AbbVie's current market cap, which is the total value of all its shares outstanding, is $378 billion. So that's going to be the price for all purposes when we're looking at the income statement and we're comparing the price to all these other metrics, performance metrics for the company to arrive at and kind of what the price is to get a sense of whether this company is priced expensive versus cheap relative to the average within the market. So this is going to be the price number, this market cap of $378 billion. So, with that in mind, let's take a look at the income statement where we see that over the trailing 12-month period, which is identical to the year 2024, we have 56.3 billion in sales. And so, to calculate the price to sales ratio, what we're going to have to do is 378 billion divided by the sales of 56.3 billion. We get a price to sales ratio of 6.7. A price to sales ratio of 6.7 is quite high in general. An average price to sales ratio in the market would obviously it varies, but it's probably ordinarily in the range of about 2 to 3. On average, here you have 6.7 for the price to sales ratio, which means that for every dollar in the company's sales, annual sales, you're paying $6.70 for that dollar of annual revenue when you buy this company. So that's pretty high, which makes this company look kind of expensive. But of course, there are other metrics to look at. And so we scroll down to net income. On a trailing 12-month basis, we see net income is 4.2 billion, and we can also tell that that's actually a steep drop off from recent years, but we'll get to that in the growth section. So 4.2 billion are the earnings, net income to shareholders. So we are going to divide 378 billion, which is the market cap, by again 4.24 billion. in net income, and we get a price to earnings ratio of 89, which is extraordinarily high. The market average is usually around 20. A price to earnings ratio of 89 is very, very high. Now, if we were to do this on the basis of $11 billion in income a few years ago, this price to earnings ratio would not be quite as high. But based on the company's current and most recent earnings, we have an extraordinarily high price to earnings ratio of 89. Let's go over to the free cash flow statement. Maybe things will look a little bit better there. If we compare price to free cash flow, so far this company is looking quite expensive. And we see that this company has actually had very, very high free cash flow over the years, $20 billion or more. That is down in the last year from over 20 billion in each of the preceding 3 years. Last year, it's only 17.8 billion in free cash flow, but that is still gonna help this company immensely if we divide the market cap, the price of 378 billion by the trailing 12 months free cash flow of 17.8 billion, we get a very acceptable price to free cash flow ratio of 21.2. So that is pretty average, I would say, for a profitable company, free cash flow positive company, a price to free cash flow ratio of about 21. And that's obviously going to be by far the best of the metrics we've seen so far. We had a very high price to sales ratio of like 6.7. We had a very high price to earnings ratio of about 89. And here we have a very acceptable, perfectly respectable price to free cash flow ratio of 21. So, moving on, we're going to look at just a couple more of the price metrics. And now we're going to turn to the balance sheet, as we always do, to take a look at the price as compared to the company's price to book ratio and price to tangible book value. And so immediately we see that this company does not have much to offer in the way of book value. Common stock equity is 3.3 billion, which is going to be negligible compared to the company's market cap. So the price to book value is going to be over 100. And then you have net tangible assets, which is the tangible book value of negative 91.7 billion. And so one way of looking at that, kind of the strictest, most conservative way of looking at that, is that you should slap this negative tangible book value on top of the company's market cap. And so you would add about another 92 billion to 378 billion, because this tangible book value, this negative tangible book value, is actually debt, which is not secured, liabilities, which are not secured by tangible book value, by tangible assets that the company could get up and sell. And so that's a liability that the shareholders have to pay off out of this company before they can return capital to themselves. Obviously, that's an oversimplification. That's not exactly how it works. The company could pay out dividends when it has debt, it could buy back stock when it has debt. But all of that said, this number, this 92 billion, could be argued that it should be slapped on top of the market cap to get a full value of what you would really be paying to buy the whole company. Because if you were to pay 378 billion to buy this company, you would accrue another 92 billion dollars of debt that you now owe, which could be argued would bring the value, the total valuation of the company, including debt, to about 470 billion. So that's that. On the price front, this company's not looking good. I mean, it could be worse. Obviously, if the earnings were negative, if the free cash flows were negative, if the revenues were non existent, then all those metrics would look a lot worse. But you're talking about a gap price to earnings ratio on a trailing basis, on the basis of not only last year, but the last 2 years on a gap price to earnings basis of close to 100. You're looking at a price to sales ratio consistently of about 6 to 7, which is also very high. Price to free cash flow ratio looks very good, although there was a dip in free cash flow last year from over 20 billion in the preceding years. That could be a sign of trouble, but that's something we'll get into in the growth section. That's not going to factor in here. Price to free cash flow ratio is really the one good thing they have going for them here. Again, of course, it could be worse. We have seen worse and we could see worse. But all of that said, we're going to give them 2 stars for price. Can't really give them more than 2 stars when their price to earnings is through the roof, their price to sales is very aspirational, price to free cash flow, again, is decent. However, the price to book and the price to tangible book value come in there and just don't really offer any margin of safety relative to the price. And so for that reason, we're gonna give them a price and so for that reason, we give them a price score of 2. Moving on to growth. And we've already seen a little bit of this, but we're just going to go through the numbers. Turning to revenue, we see that this company's revenue has not grown. In 2024, revenues were the same as 2021 and actually lower if you were to account for inflation. 2022 was a bit of a jump over 2021, largely probably eaten up by inflation at that time. 2023 was a dip. 2024 sees a slight rise from 2023, but overall, this revenue trajectory has not looked good in recent years. Not any growth here and struggling, it looks like, just to keep their top line going. However, their gross profit really grew in 2024 as compared to the prior year, not just by 2 billion, but by 5.5 billion. And so that's something that is worth keeping an eye on. But all that said, if you look back at 2021, 2022, gross profit has not grown over 2023. So for whatever reason, it looks like they had exceptionally high cost of revenue in 2023. Thankfully, good that's back down in 2024, that cost of revenue, which contributes to a nice increase in gross profit. But if you look back at a couple years ago, that doesn't look like growth at all. It's actually down from 2022. So again, nice growth over 2023, but no growth over 2022, 2021. So moving on to earnings, and we already saw this earlier. We got a hint of what this is going to look like. It's going to be a bit of an ugly number. If we look at the net income to common stockholders, we see that in 2021 it was over 11 billion, 2022 close to 12 billion, 2023 that gap net income suddenly falls off to 4.8 billion. So that fell by a lot, a lot, somewhere between half and two thirds. And then a further decline in 2024, not looking good on the bottom line. This bottom line is headed in the wrong direction. And so then let's quickly move over to the cash flow statement. And again, we see that as we noted previously, this number has fallen not as badly, not nearly as badly as the net income number, which is a lot lower. However, the free cash flow number is also of late heading in the wrong direction, peaking here in 2022 at over 24 billion, falling to 22 billion in 2023, and falling to 17.8 billion in 2024. Again, headed in the wrong direction. But before we write AbbVie off as not growing, as stagnant, let's take a look at what the analysts following this company think. So, in terms of net income, and this is going to be non GAAP net income as opposed to GAAP net income, which is what we saw in the income statement. So, we get a little taste of both in here, which is fair in terms of these scores. In terms of the earnings per share, year ago, non GAAP was 10.1. In terms of the average estimate for the current year, that would be 12.27 per share in net income. That would be very nice growth. That would be about 20% growth year over year in non-GAAP net income. The following year in 2026, they're expecting another very nice double-digit increase to 1381. And so that is a very good sign. As you can see, there are a lot of analysts covering this company. It is a huge company. In terms of revenue, we see a nice projected bump this year to 59 billion, up from 56 billion last year. And then the following year, an even bigger bump to 64 billion. And so they're expecting that next year in 2026, there will be 64 billion in revenue, up well over 10% from 56 billion in 2024. So, with all of that said, AbbVie is going to get a fine score for growth. The reason being that although it has not been growing, the analysts who are following this company a lot closer than I am believe that growth is going to come back, that growth is going to accelerate, that growth is going to, as soon as this year, return again, rear its beautiful head on both the top line and the bottom line. And for that reason, we're going to give them a middle of the road score on growth, even though their recent growth has looked really bad. And we thought they were heading for another underwhelming score in this category, but we're going to give them down the middle a 3 for growth based largely on these analyst estimates. Now, as we've said before, analyst estimates should always be taken with a grain of salt. That said, these analysts, these 24 analysts, 25 analysts making forecasts for the next couple of years, they're following the company a lot closer than I am, and chances are a lot closer than you are. And so we are going to give these estimates a nice bit of weight on the growth front, and for that reason, they get a 3 on growth. Moving on to our next consideration, financial position. So let's take a look at the balance sheet to see how this company is doing. We already got a bit of a sense of this when we were looking at the price. We saw that this company does not have any sort of security blanket on its balance sheet. No unencumbered cash reserves, no huge amount of tangible assets. And although they do have a lot of assets that even offset their liabilities by a few billion on paper, as we saw, that is not the case in terms of tangible book value, which doesn't exist on paper but exists in tangible reality. And that's where a lot of the value seems to slide off their balance sheet. Let's look here at total assets. We see total assets are 135 billion, total liabilities are 131 billion. However, if we dive into these assets, we are going to see that although they do have a bit of cash, which has actually really fallen, their cash reserve has really fallen from recent years for some reason. That doesn't necessarily mean anything. We're not going to read too much into that, but we see they, have 10 to 11 billion in receivables. They have 4 billion in inventory, and those are basically their tangible assets. Now, as for their non-current assets, they do have net PPE, plant property and equipment of 5.1 billion. That's their net PPE, which factors in, as you see here, accumulated depreciation. But then goodwill and other intangibles. Goodwill is basically the excess purchase price that they paid on acquisitions, and we see that this number has been pretty steady, up a little bit last year. Other intangibles of 60 billion, I don't know what those are, but that is a huge number, which I would encourage if you are going to consider taking a long or short position in this company. I would suggest it might make sense to figure out, take a look at the annual report, figure out what these other intangible assets are, because that's a huge, huge number that makes a massive difference, a $60 billion difference potentially in the valuation of this company, one way or the other. Other non current assets of 9 billion. Okay. And then we have liabilities. Let's see quickly what the liabilities look like. We have current liabilities of 38 billion. So right off the bat, that 38 billion as compared to this 25 billion, 25.6 billion in current assets, that is not what you want to see. If anything, you'd want to see these numbers reversed. You'd want to see the 38 billion number in current assets and the 25 billion in current liabilities. The reason being that current assets are the assets that the company has, which are liquid or could be liquid within the next 12 months, which are expected to be liquid within the next 12 months. What are those? As we see, cash, receivables, and inventory. Other current assets a little bit, but primarily cash, receivables, and inventory. That's the money that is expected to come in the door, that either is already sitting there in the bank account or is expected to come in the door over the next 12 months. And then you have, that's 25.6 billion. Then you have current liabilities of 38.7 billion. That's the money that has to go out the door in the next 12 months. Well, if you only have 25.6 billion to cover this 38.7 billion, where are you going to get the rest of that money from? Either you're going to sell assets or you're going to take out more debt. That's not good. And so you would like to see a better ratio here, of current assets to current liabilities. The conservative value investors aim for a current ratio of 2, which means that current assets are at least double current liabilities. And here you have that going in the opposite direction, where you have current liabilities that are a solid 50% plus higher than the current assets. So that's not good. Going on down, we also have non current liabilities, which are the vast majority of liabilities at 93 billion, and 60 billion of that is long term debt. So, this company's financial position is not so great. They have all this debt. They don't have tangible assets to kind of back it up. They have all this goodwill from acquisitions, all these other intangible assets. And basically, just the financial position is not good here. Now, I'm not saying that they're going to go bankrupt or insolvent. I very highly doubt that they will anytime soon. Obviously, a company like this can get the funding it needs to keep going under most ordinary circumstances. They are profitable. There's no reason for them to, face insolvency other than the fact that they have all this debt and all of this negative tangible book value, which really, just supplements the price that you're paying for this company. Turning back to the income statement, let's see if we can find what this company is spending on interest. Interest expense is a little over 2 billion a year, now closer to 3 billion, I guess, as their debt went up a little bit and their interest expense also. The interest rates rose, and so their interest expense rose as well. But we see a consistent theme of about 2 to 3 billion a year in interest expense, and for a company that has a 378 billion dollar market cap, I'm not going to say that paying 2 to 3 billion in interest a year is going to make or break this investment, or even be one of the top 5 or top 10 factors to consider. But at the same time, we are assessing this company's financial position, and the fact that they are sending all this money out the door is a drain. It's a drain on their book value, which is virtually non existent. It's a drain on their tangible book value, which is very, very negative. And so, not a good sign. For financial position, we've seen companies with way worse balance sheets than this. There are many, many companies out there with way worse balance sheets than this, which would also likely have more difficulty raising money if they were going through a rough patch. All of that said, the financial position for AbbVie does not look too great. It may have been a little better in years past, maybe not, but in any event, right now it doesn't look too great. For that reason, we're going to give them 2 stars for financial position. Finally, we turn to management. And as always, our assessment of management is not based on anything subjective. And so we're not really offering an opinion on the management team. As always, we're just looking at a few objective metrics that give us a sense of possibly how this management team is performing. Management team performance is such a subjective thing. There are so many factors. And of course, there's often disagreement about how a management team is performing at a company. So, all of that said, let's dive into it, looking at the few metrics that we look at, starting with earnings surprise. So, we see that in the last 2 years, they beat on earnings 3 times and missed on earnings 5 times. On revenue, they beat 6 times and missed twice. These are pretty middle of the road numbers. I like the revenue beat numbers, don't really like the earnings miss numbers where they missed 5 times out of 8. All that said, this is pretty straightforward, pretty 50-50. Sometimes they beat, sometimes they miss, like most companies do. With that said, we turn to recent insider transactions, where in the last 6 months, insiders have purchased way more shares than they've sold, which is good. That said, if we look at these purchases, we see that they were at least largely, at least somewhat, conversion of exercise of derivative securities. So basically, that means that these executives, the company insiders, are being awarded options or warrants to purchase shares at certain prices. They're exercising those options or warrants. Those are the purchases. Now they are paying something. They're paying whatever the price listed on the warrant is. That said, presumably they are executing these warrants at below market prices. All of that said, they're not selling these shares immediately. We see they're purchasing these shares and holding on to them. They could dump them onto the market if this was just a way for them to kind of arbitrage the price difference between their warrants and the market price. They would be buying and then they would be selling. We see there is some insider selling, which there usually is, especially for such a massive company. However, the purchases, even if they're not open market purchases, even if they're the exercise of warrants, they're still holding those shares, which is a decent sign. So, putting all this together, again, I think this is a pretty average, pretty middle of the road insider transaction thing. We don't see a lot of sales relative to the stock price, which is good. And we don't see any signs here that insiders lack confidence in this company, which is good. Turning to share count, we see that the share count has been very stable, very steady. The company's had 1.7, closer to 1.8 billion shares outstanding, and that has remained steady, which is good. We also see on the cash flow statement that net stock issuance has been negative, which means that they've been buying back more shares than they've been issuing. We see they are buying back stock. We also see they're spending significantly more money on dividends, paying, I guess, a decent yield, close to 3% when you compare this amount to the market cap. So that's a close to 3% dividend yield. So that's good too. All of that said, for management, and again, we're not really putting a value judgment on management. It's not really within our ability to do so, but we're going to give them a solid 3.5 stars based on these metrics. Looks very good. 3.5 stars. So now for the fun part. We have our scores in the various different metrics that we look at. AbbVie started off kind of weak with a 2.5 for industry and a 2 for price before getting a 3 for growth, a 2 for financial position, and a 3.5 for management. If we were to take the average of those five scores, that would be 2.6. So that's going to be the blended total score for AbbVie, 2.6 stars as of today. Thank you so much for tuning in once again to A to Z Equities. So happy to have you join us. Feel free to like and subscribe if you appreciated this video and would like to see more content from A to Z Equities. Till then, have a great day and a great life. Thank you.